Hello, welcome to Your Affordable Home Show. I'm your host, Stephen Mitchell, coming at you live from Preston Village this week, mobile home park here in Louisville, Kentucky, my hometown. So I thought this week we'd talk a little bit about interest rates. I know it's on everybody's minds. When are they going to get less? When this thing's going to ease up? And nobody's got a crystal ball. I'll just be honest with you. I thought I'd give you a little backstory, and again, I'm not an economist, so don't take my word as gold. But back in the early 70s, also late 70s, early 80s, there were oil embargoes for various reasons, but it's something that we can kind of go off of. Okay, it was a time of inflation, and it was a time of monetary correction, and that was the highest we ever seen lending, was actually in 1981. Okay, 1981, you had mortgage rates at an all-time high of 18.63% average. The rate that I like to look at is the federal funds rate, which back then was, I believe, 81 hit 22.63%. If you want to compare it, because manufactured homes is kind of like, a lot of times it's financed similar to a car because it's personal property, unless it's tied to the land. So back then, personal loans on vehicles averaged 81, I believe it was a little over 16%, so it's pretty high there too. But that's kind of the highest that loans lending ever reached. And again, if you look at the federal fund rate, that is actually it's the rate that banks can basically lend money to each other. I scratch your back, you scratch my back. We can lend money amongst each other. This is our internal rate that we are lending each other money at, and I like to look at that. So before I get on to today, if you're liking this content, if you're liking the messages that I'm bringing each week, wherever you're watching this, please like, subscribe. Check us out on our Facebook group, Your Affordable Home Specialist. Those are all great places to get information. There's also a Facebook page where I post content there. Keep up with us. There's a lot of great education that you can give yourself. Moving on to today. So today we find ourselves, the federal fund rate it's at anywhere from 5.25 to 5.5%. Okay. Your prime is going to be higher. Usually your loans are a couple percentage points higher than the federal funds rate. So just set by the Federal Reserve. And us as consumers, they're going to make us pay our fair share, I guess you can say. So that internal rate that banks scratch each other's backs with, that's that. But consumers are going to have to pay for their loan products, their money. So think about that. A lot of mortgage rates right now, conventional mortgages, are just shy of 7% right now. Okay, and this is mid-September 2024. So just shy of 7%. Again, pretty much on average a couple percent and a half, 2% higher than federal funds rate. So what impacts this? If you look at affordable housing over time, through history, the rates, depending on what type of loan product, and I'm not getting into specific loan products on manufactured homes, but just rates in general, anywhere between 4% and 20% historically. That's kind of where the rates have fell. Right now, on manufactured housing, you're looking anywhere from 8 to 14% average. Credit score affects that. A lot of factors, down payment, there's all types of things, debt to income. Those are a lot of things that factor into what type of rate you actually get. But on average, 8 to 14%. So will interest rates come down? Well, again, we're still battling some inflation. Okay. What can make it go down? Well, some of this is just supply and demand. The pandemic really didn't help supply any. In fact, it shortened supply while there was still heavy demand of different things, just all types of products. So that's easing up. The supply is getting there. It's becoming available. That's really, that's easing up. So we've seen some slight ease with the federal fund rate. We've seen some slight ease when it comes to loan products and the interest rates attached to those loan products. When you go back to, say, 2007, 8, 9, the real estate crash, if you go back there, there's something that can also cause problems, which would be the cost of money being too cheap. And if the cost of money is too cheap, that causes a whole nother set of problems. So what you've got to do is you've got to try to figure out how to find this middle ground between supply, demand, the cost of money, and the other factor is also energy cost. So energy costs haven't gotten any less. Energy is basically getting more and more expensive as time goes on. So if energy can be cheaper, oil's part of that, but if energy can be cheaper, if supply is there, and as long as you don't make the money too cheap, I think interest rates on a mortgage, conventional mortgage, got down to 2.65%, which, and I think that was as recent as 2022, I believe. Don't quote me on that, or maybe 21. But yeah, so if you don't make money too cheap, and you also, you got to regulate those loan products. In other words, you can't lend the money to people that, even if it's cheap, can't lend the money to people that shouldn't be getting the loans. That makes sense. That was another problem with the real estate bubble back in 07, 08, and 09. So you've got to give the money to people that can actually afford it. If you can put all those factors together, the cost of money, make sure it's fair but not too cheap, supply, make sure supply is good, and if you can reduce the cost of energy, then you will probably see the federal funds rate drop, and you will also probably see your loan products get cheaper. Your interest rate attached to those loan products get cheaper. That's my take. That's my thoughts on it. And again, I'm no economist, but remember this: home ownership empowers the American dream. So that's my 2 cents for this one. Signing off, Stephen Mitchell. Peace.